From 2015 through mid-2019, crude oil and 10-year yields traded with a strong positive correlation. This makes sense as we generally associate rates rising in tandem with an improving economy and some concern of future inflation. Crude oil tends to view those same forces as a price tailwind too. However, from March of 2021 until early July, this correlation completely broke down as crude oil prices shot higher and 10-year yields moved significantly lower. Although the fundamental drivers of the decoupling are not completely clear, many traders believe it was a combination of a massive unwinding trade in 10-year combined with the implications that the Federal Reserve was committed to keeping rates low. In other words, if the market believed that perhaps the Fed had a somewhat of a mental cap on 10-year yields at 2%, then the risk-reward of holding those long positions faded. Now, since the beginning of July, the correlation has resumed. As crude has headed lower, rates have also headed sideways to lower. Now, if a trader is short crude oil and believes that a move higher in rates could precipitate a coincident move in crude, as an example, they could buy the 10-year September, it's not the August contract anymore, micro yield contract priced in simple yield terms as a hedge against their crude position or as a directional trade. An example of this would be if they bought the contract at the current level of 1.3, they could target early April highs of 1.7. If that trade's successful, it would make 40 basis points at $10 per basis point or $400 per one lot. Now, conversely, if a trader was long crude and was concerned about rates moving lower, they could sell that same September micro at 1.3 and target the January lows of 1 even. If successful, that trade would make 30 basis points or $300.